What is up, everybody? Happy Thursday! Welcome back to Benzinga Live. I missed you guys yesterday. Hope you guys missed this show as well. We are going to be talking about Apple's earnings today. We'll be doing some recaps of the other earnings we've gotten this week, including Meta's last night. We also have, of course, Amazon's and Google's that we haven't recapped since we did not do a show yesterday. Here at about 11:45 in 10 minutes, Steve Kalajyian will be joining us from TradeEZ. Steve, if you haven't been on with us before, maybe has the most impressive setup out of any trader we bring on the show. He's got about 30 screens behind him with different tickers he's watching. In the past few times Steve has been on the show, I do got to give him credit. He's hit the nail on the head when he's pretty much predicted exactly where the market's going to go to. Buglog, yep, your swag should be on the way. We are going to do a quick checkup on all those swag items. So if you're owed a piece of swag and you haven't gotten one, now is your time to speak now or forever hold your peace. But remember, we do have records of those, so you can't just say, oh yeah, you owe me something, but we really don't, because we will know. As far as your top headlines of the day, let me go ahead and get my Benzinga Pro pulled up. We did get yesterday after the market the news that Manchin, the senator from West Virginia, is finally agreeing to a spending package. And as a result, all of these clean energy stocks are just absolutely running today. I've been watching Sunrun, which is a big holding, and my Roth IRA up 25% today. So some of these different names in solar, right? We can just look at the TAN Solar ETF up 7%, but whether you're looking at Array up 20%, Run up 25%, a lot of these solar names running today. And yeah, let me know again in the chat what else you guys are watching. Of course, we're going to check out the Qs up about almost 0.3% now. And that was while we were down a full percentage point earlier. So a nice bounce back on the Qs here. Let me know if anyone got in on this trade, got in on any sort of bullish action today off that dip, because it does seem like, I'm not saying, the bottom's in, we're through all the pain, but at least it seems like in the short term, the trend has been positive. You can see we're looking at a daily chart here of the Qs, and going back a month ago to June 16th, we did hit that low in the 260s, and since then, we've risen about 50 points. So it's showing that people out there, maybe that were on the sideline, maybe some institutional money on the sideline, has come in over the past month or so, starting to buy up. Volume is still a little bit lower because it is still summertime months, but as we get into August, August in particular is a very slow month. If you think about it, August is the time of the year where a lot of Wall Street, a lot of people in New York City, start kind of going out to their vacation homes in the Hamptons and Jersey Shore and whatnot, and trading volume continues to be low throughout August. But while we get toward Labor Day and the later part of the month, people start getting back to work more. So I anticipate if we are able to kind of, hold these levels and not get back to retesting these lows, that, hey, we might see more and more that institutional money coming in, creating more stabilization, because everyone was waiting, to really hit this capitulation point, get to VIX above 40 and get to the point where everyone was selling because they had to sell, not because they wanted to sell. But now, I don't think we've really gotten anywhere close to that point right now where you can say, okay, yeah, here's like capitulation. It's been a tough ride in the markets, and now, it looks as if Wall Street is saying, hey, things aren't as bad as people are saying. We will talk GDP. We will talk the biggest debate going on right now, whether you're on, FinTwit, whether you're on, whatever, is what is a recession? What constitutes a recession? Are we in a recession? And, a lot of people out there are, okay, 2 consecutive negative GDP growth, recession. And that is, and we'll talk about this. We'll play the intro. We'll talk about this. I want to see where the audience stands on this. But without further ado, let's go ahead, roll that intro, and get the show started.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. All right, guys. So yeah, that is the big debate. The GDP numbers came in a little bit lower than expected today. We'll go ahead and get that pulled up from the Fred, the gross domestic product here. And I don't know. I mean, here's what I want to point to, um, because this so a lot of things like this, like a recession, right? Being two negative quarters of GDP growth. That is kind of it's what I would say a definition out there. Like there's no economic dictionary that lists this as the end all be all definition of a recession, because if you think about it in terms of what a recession means to a consumer, what a recession means to a worker. I wasn't in the workforce in the '07-'08 recession. I wasn't, I was a kid for that. So I don't know what it was like, but from what I've heard, it was bad. It was bad to be a worker. It was bad to be a business. And really that hasn't been the case. Here's what we'll do. Let me pull up I'm going to pull up the unemployment rate straight from the Fed, because even though the labor market is showing signs of cooling, right? If you look at the unemployment rate, let's do let's bring this range down. So this is to June. All right, I guess this is only going to give us to June 1st because this is like the real. Let's do unemployment rate real time. I want to get a chart. Here we go. I mean, like to me, the recession thing, it doesn't make sense when you still have unemployment falling. If we see unemployment starting to tick up, and I've been saying it on this show for the past 2 months, I don't really care. Like I'm not that worried seeing Carvana, seeing Netflix, seeing Twilio lay people off. I'll be really worried when Walmart, when UPS, when FedEx, when companies like that start to lay people off. And with that said, like Monday when Walmart came out after hours and gave their, lowered their profit expectations, that was worrisome. Because I was saying, okay, that's not just some high growth tech companies showing growth problems. That's Walmart showing, profit and growth problems. But you had Walmart saying that, and then you had other statistics coming out saying that consumer spending is actually not terrible right now. So I don't know. I mean, I just like call it what you want it. Like the economy, we've gone through a couple tough quarters in a row. You can look around, you can look outside and say, okay, you can think we're heading toward an '07-'08 recession. If you think that's the case, then sell stocks and buy puts or whatever. But I personally, like from what I can see from when I've traveled recently, from when I've gone out, like it seems like to me people are still spending money, and the biggest problem we've had is inflation. And from a lot of metrics we're looking at, inflation's coming down at least in some degree, right? We've been checking this gas prices page. A month ago, the average price for a gallon of gas in the country was $4.88 a gallon. Now it's $4.28 a gallon. Still way too high. I don't want to pay $4.20, right? You can see up here in Michigan, we're actually paying more than that. We're paying about $4.32 a gallon. That's still way too high for me. But a month ago, if it was $5.10 for me, and now it's $4.30, that's more money I can spend on other areas. Shelly saying people are spending money they don't have. Yeah, we've seen credit kind of reaching pretty much all-time highs right now, but my only, I guess, the spin zone to that, you can think, okay, people are dipping more into credits. People are spending their savings. That's all going to hit a tipping point and going to blow up. Or the flip side to that is, okay, people have been dipping into their savings, racking up more on credit as we've been in this high inflation period. As inflation comes down a little bit, people will be able to pay off those credit cards a little bit better, and maybe, who knows? And then that ends up not being that big of a deal, because you get the multiplier effect of more people spending money in the economy. It creates more opportunity, creates more jobs, ends up creating more money, and ends up being a windfall effect for everyone. So I just am not to the point right now where I'm looking at some of these numbers. Like, there are a lot of people out there, whether you're Michael Burry, whether you're the guy who wrote Rich Dad, Poor Dad, calling for this huge recession, huge stock market crash. There's a lot of data out there that refutes that. I mean, consumer spending still grew in the last quarter. It grew at a slower expectation than it was expected, but consumer spending grew. All right, guys, give me 1 second. I'm gonna catch up on the chat real quick. Easy Mike's talking about Lending Tree, get an idea on Affirm, PayPal. Let's do it. Give me 1 second. Let me get my Benzinga Pro pulled back up. All right, guys. Let's take a look at Lending Club real quick, or Lending Tree. I always forget. I forget this stock exists sometimes. Lending. Oh my God, Easy Mike. Look at this chart. This thing is disgusting. All right, so you're down 3% today. Let's go through the numbers real quick. This is what's great about having Benzinga Pro during earnings season, is it makes it very easy to go through these different stocks and check out what they did during earnings. So Lending Tree, wow, actually beat on EPS. Sales miss, though. Stock trading lower. Cutting guidance. So, all right, earnings. So Lending Tree, I assume, Easy Mike, I don't know too much about this company, but I assume they do personal loans, like, or they do like some sort of buy now, pay later. Let's see. Peers. Lending Tree that principally engage in operating an online loan marketplace. So it sounds like it's more of a competitor to Upstart. You can see Upstart kind of trading down with Lending Tree. I don't know. I mean, Upstart's kind of interesting down here, to me, honestly. To me, honestly, guys. Like, let's check out the price to sales, 2.2, forward PE 35. So still kind of expensive here on Upstart, but this company makes money. Why do I think people will be able to pay back their loans? I don't know, because Pete, that's what these companies do. That's what like Upstart does, is they own their proprietary AI, machine learning algorithm that vets people based on their ability to pay back loans. And if the AI says, okay, this person's a candidate, then they lend them the money and people pay back the loans. I mean, I don't know. People always freak out about different loans and credit card, and for the most part people repay them. Like, there are certain times, right, Shelly? I see you bringing up 08. Like, there are certain times where these loans get overextended, and I mean 07, 08 was really a lot of kind of perfect storms coming together, and that was foreseen by a lot of people, Michael Burry and Steve Eisman, or whatever the other guy's name is. They saw that coming. They said, okay, look, there's no way these people are going to be able to pay back these loans. And I don't think that's really the case with a lot of these loans coming out right now. Like, a lot of those loans in 07, 08 got worse over time. People actually had to pay back more as the years went on. Like, for the first couple of years, the rates were lower, and then the bigger rates started kicking in. And I don't think that's really the case with like Upstart or a lot of these companies. I've looked into them, and it seems like, hey, I mean, if I applied for, oh yeah, wait, Shelly, they do facial recognition on the AI. I went on Upstart and I applied for a loan, and they were going to give me 15 grand. I was going to have to pay 17 grand over 3 years. So I was going to only have to pay like $2,000 over 3 years for a $15,000 loan. And it was actually pretty reasonable, I thought. All right, guys, let me text Steve Kalajyian. He should be coming in any minute now. That doesn't seem right, Shelly. It's not good. All right, guys, let's do another quick check on the overall market. The S&P 500 is up. Wow, we're kind of ripping here now. Let's go to a 5-minute chart here, see what we've been doing the past few minutes. Your Q's up about 0.4% here, so it looks like we could be turning over. Really a lot of eyes here on Apple getting ready to report this afternoon. Oh my God. All right, hold on, we gotta get this fixed. Is anyone playing Apple with any calls or puts today? Let me know in the chat if you guys are planning on playing Apple. Buglog wants me to look at JetBlue. I believe they are getting ready to purchase Spirit Airlines. Let's go over here in the news tab, see what's going on. Spirit Airlines locks a deal with JetBlue, creating national low-fare challenger. JetBlue agreed to acquire Spirit Airlines for $33.50 per share in cash. The transaction consideration implies an aggregate fully diluted equity value of approximately $3.8 billion and an adjusted enterprise value of $7.6 billion. Jonathan, let me know how you're playing that. Risk it for the biscuit, says might YOLO some 160 calls for 3-4 weeks out. We'll take a look at the Apple options chain here in a second. All right, let's see. Purchase of the price includes a prepayment of $2.50 per share in cash is payable upon Spirit stockholders' approval of the transaction, and a ticking fee of 10 cents per month starting in January 2023 through closing. This combination is an exciting opportunity to diversify and expand beyond our network, add jobs and new possibilities for crew members, and expand our platform for profitable growth, stated JetBlue CEO Robin Hayes. This is a compelling combination that provides meaningful protections for stockholders. So it sounds like this is a done deal. JetBlue stock is trading lower. Typically, the market does not like the company that's acquiring another company in these deals because it can sometimes dilute shareholder value in the short term. Let's take a look at how Spirit stocks are doing. That's ticker SAVE. So interesting. This is actually a pretty big discrepancy here. So $33.50 a share. You're only at 25 right now. So the market isn't pricing in this being like a sure thing. The market's saying, it sounds like there's still some voting or whatever that needs to be done on this deal to get it finalized. But right now, the market is not saying this deal is a done thing. Speaking of, I haven't checked out Twitter's stock in a while. Again, keep in mind that the buyout price for Twitter here is $54 a share and 20 cents. So right now we're about $14 off that. You can see with Twitter, we dipped to around like 32, 33 bucks a share, but since then we've recovered a little bit. And I think that's the market here saying that they like Twitter's chances of forcing Elon Musk to go through with the price, because otherwise this thing would be trading well below $40, right? You can look at any other social media company, whether you want to look at Meta, whether you want to look at Snap, and just see how poor they've been the past few months. And Twitter's held up specifically because of this deal, because there is still faith that this deal is going to go out at this $54 a share, which would be a nice little premium from here. I mean, if you think about it, 20% from $40 is $8. So you're getting like 35% to $54 from here. So if you think the Delaware court system is going to enforce the Twitter deal and make Elon Musk buy Twitter at the agreed upon price, then this is a hell of a deal to buy Twitter stock at $40.26 and potentially get $14 out of it in here a couple weeks. Jonathan Lovelace, the market will not be when everyone is screaming the bottom is in, the bottom is in. Yeah, Jonathan, I mean, the problem the problem is like the past 6 months, the past 8 months or so, really, we've had a bunch of just macro headwinds in general, things not helping out. You know, whether you're talking about China being shut down for like 2 straight months from February to April or whatever, and Shanghai and Beijing and all their biggest cities completely shut down, whether you're talking about the war in Russia and Ukraine creating kind of these new unforeseen supply chain issues, weather, catastrophe, whatever it is, like we've held up through a lot of these things pretty nicely. Like the market's still down 20%, whatever. But like if a lot of these macro situations start getting better and we've gotten through what we've been anticipating to be like a really bad earnings season, it's not as much about from a market standpoint of, okay, we need more pain here. It's like these things are always changing. It's like it's all relative. So SPY at 400, if we get some good news out of Russia and Ukraine and China says, okay, we're going to get rid of our zero COVID policy for a little bit, we need to get back on track economically. Like all these things could happen to where then, okay, SPY at 400 is very cheap. And the other way it could go around too. I mean, monkeypox could continue spreading, and then the next thing we're looking at is different countries shutting down their economies again, and then 400 on the SPY is looking really expensive. So I think it's not as easy just to say the bottom is in or the bottom isn't in. A lot of people, myself included, had very low expectations heading into this earnings season, and for the most part, the bigger names, whether you're talking about Netflix, Amazon, Google, Microsoft, have held up. And we'll see with Apple today. I mean, I could see Apple missing on earnings just because if you think about from Google and Microsoft, their cloud part of their business was amazing, but their Xbox, like the actual hardware part selling Xboxes, wasn't as good. And I could foresee that with Apple saying, Google and Microsoft did okay and Amazon did okay with their cloud business, but Apple's a lot more reliant on actually selling hardware, on selling laptops, selling iPads, selling AirPods and phones. So I wouldn't be surprised if this past quarter wasn't as strong for Apple. But I mean, even if that's the case and say Apple's down 6% after a disappointing report and SPY's down 1.5% tomorrow, like I don't know where else a lot of this pain for the big guys will come from, especially when you're looking at a stock like Google. Like Google's gonna have buyers at $100 or whatever. Like looking at this chart on the daily, and this is obviously split adjusted. Google, we were at 150 a share. So down to 100 is a 33% drawdown, a third. There are buyers down here. You can see that right here where we were barcoding. Even when headlines were bad and market sentiment was bad, we were barcoding down here on Google because we got a lot of buyers down here. You have this support like right here at almost 100 flat, 100 at 105. So a lot of these big names to me it'll be interesting, I guess, to see if they really end up dropping anymore, because I think the next big catalyst you got to wait for is like not till next earnings report at this point. It will come from the consumer being tapped out, and the consumer isn't tapped out yet. Bottom's not in. Yeah, I mean, certainly a possibility. We shall see. All right. I don't know where Mr. Kalajyian is. Should be joining us any minute. How's energy looking? Oh, sorry. Cody's wanted to check this out for a minute now. Let's check out the XLE. We'll start there. Up about 0.4% here, you can see. So up 3.39%, so a little bit less than SPY today. So XLE is actually lagging, but let's check out what's been the strongest, which is Natty Gas. UNG, the United States Natural Gas Fund, is actually down about 2.5% today. So checking out KOLD. I mentioned I was watching this earlier. This thing, so I traded KOLD. I called this out on the show about a month ago or so. Just when Natty Gas was getting a little bit overextended, I bought some KOLD, which is the short Bloomberg natural gas. So if natty gas goes down, the KOLD is going to go up. And it was just when we were getting a little overextended. And I bought it out here at around 16 bucks. It ran up to 40. I sold it at like 25 or 30. So I made a few bucks, but I would have made more had I held it. But now we even got lower than that price that I originally got in at. And really, I mean, natty gas, like I'm still bullish natty gas right now because we've seen what we've learned over the past 6 months or so from this Russia-Ukraine situation is even the countries that are furthest along in clean energy in Europe, whether you're talking about Germany, whether you're talking about France or whoever, still, we're still not quite there yet. And natural gas is really the best stepping stone as we're getting toward that more renewable, as we're getting off of coal and fossil fuels. That natty gas can kind of be that stepping stone. But it doesn't, even if I'm bullish it in the short or in the medium to long term, I can still think we're overextended here. And I do think here with this cold, it could be a nice little opportunity to come scalp some in at 14. Maybe you just hope for a nice little rip up to like 20, 25, and you come in and sell some. But definitely the strength has been here. I mean, let's go back to that UNG chart on the daily and just pull out. We did have this big dip here where we got overextended, and now we've gotten kind of back up to there. But KOLD definitely interesting. See, we've got Mark in the chat. The bottom can't come unless one of three things change in the world, causing economic tension, war, inflation, interest rates. If any of these things. And that's what I honestly think right now. You're seeing the market in real time kind of digest this idea that we are seeing inflation fall, at least in some areas, right? Gas mainly. We've been checking that AAA gas website almost every single day. And what I've been checking for is basically that turning point where we've had gas prices falling each and every day, and then they start to kind of stabilize out or maybe even tick back up. But so far, we haven't seen that. They've just continued even going down pretty much every single day. And that's kind of reverberated out throughout some other parts. Walmart, when they came out with their profit warning, said, yeah, inflation in fuel and inflation in food prices is changing the way people are spending. What is that causing us to do? Well, we're spending too much money on housing inventory, so we're going to start slashing prices on things like clothes and household items. So now you have inflation in some areas, food and gas, leading to deflation in other areas, apparel and home goods. So, I mean, like, we'll see. I think a lot of these macro things that we've been seeing play out over the past 6-8 months or so, sure, some of them will still be bad and some of them may still get worse before they get better. But over time, that tends to be the case, is like these supply chain issues arise after the war with Russia and Ukraine. And over time, they get better. That's just what happens. So the bottom line here for me right now with the overall market is it's pretty simple in terms of, if you think, okay, we've gotten through a lot of these macro headwinds. Things haven't been great. You look at a lot of the big names. You look at Google. You look at Microsoft, and we're still down 25% from our highs. Still a decent buying opportunity, especially if you're buying for the long term. But if you think, okay, this, we've gotten lucky so far getting through the earnings season unscathed. We still have a big recession coming. Then, yeah, maybe you want to hold out. Maybe you want to sit on some cash, So it's really dependent on if you think we're heading toward this big economic slowdown and recession. And like I said, there's a lot of data out there pointing to the fact that that's a realistic possibility. And there's some data out there that's saying, no, things are decent right now. And in any other time, if you look at 07, 08, if you look at, even recessions before that, you can really see unemployment starting to rise, not just when the recession starts, but into the recession, right? You have the economy kind of slowly turning down into recession, and then it hits a point where things start to break and then more people get laid off. But we haven't seen that right now. We haven't really seen unemployment ticking up in the sense. So I mean, I get it. I see a lot of people out there. A lot of people are asking me, almost mad in a way, like, why are we up, 3% yesterday? This makes no sense. Like, the economy is not that great. And it's like, look, you have all the opportunity, just like everyone else out there, to do your own research, to find different data points. Some may corroborate your argument or your feeling about the economy. Maybe you hate this current administration, so you think the economy is terrible right now, and you think any numbers that coming out right now that indicate the economy is not terrible is bullshit. Or maybe it's the other way around, where you love the administration right now and you think any numbers coming out right now saying the economy is bad is bullshit. But you have to put those biases aside. You have to be able to understand that you're in a position like everyone else to go out there, do your own research, take in this information, and then decide what you think is going to happen. And your guess is pretty much as good as anybody's. I personally don't think, everything's all rosy and dandy, but I also am not buying into this whole doom and gloom. We're going to see an 07, 08 recession and stock market crash, and things are going to go down another 30% from here. I haven't seen any data to really back that up. I haven't really, just because some people feel that way, just because some people feel like things are the worst they've been in 20 years, whatever, it's like, feelings are feelings. Then you have numbers, and the numbers for on some ends, like I'm saying, don't look great. And then on other ends, look okay. So I think it's a very confusing time right now. I think a lot of economists right now would tell you that too. And I think the ones that would tell you that it's not really a confusing time right now would be lying, because it is. But I do think you have, for those people that are kind of like mad right now or wondering like, oh, why are we up 3%? Like this makes no sense or whatever. You can look at some of these things like, okay, you have some real time data points indicating that inflation is cooling. Does that mean inflation's gone? No, of course not. Inflation's still way high, and inflation's still way high for comfort, but there's data coming out that it's cooling in real time. So people are going to see that as bullish. It goes both ways. If you're going to see inflation as this super bearish thing for the market, and every time we get a hot CPI print, the market's going to tank, then it's got to go both ways. You got to be bullish then when the inflation numbers are cooling down. So we'll see. Shelly, when I say some numbers that look okay right now, like I'm talking about how we've gotten surprise beats on unemployment numbers, consumer spending still grew. Gas prices have been falling for 30 days straight, showing that inflation could be cooling down. So, all right, I do see Mr. Kalajyian hanging out backstage. So let's go ahead and give Mr. Kalajyian our very special introduction. I mentioned earlier, one of my favorite setups for any investor or trader we have on the show. So without further ado, let's give him our special intro and bring Mr. Kalajyian on the show. Steve, how are we doing today?
Hey, Aaron. Good morning. Good afternoon, everybody. Sorry I was a little late. I wasn't feeling too well. I'm sorry.
No worries. Hope you're feeling okay.
I'm doing well.
So we've had a busy week, Steve, between earnings, between the federal fund rates coming out yesterday and FOMC. What's been your take on the week so far?
Well, again, one of the things I tell people all the time is like, I've been around this August 1st, 39 years, and short covering rallies are more vicious than bull market rallies, right? So we printed that low of 36.42. We hovered around. Remember, I told you last week I was looking for a pullback to a higher low. We got that down to the 39.15. Then we pushed we pushed right back up again here. I still continue to think that we have a ton of overhead resistance here, that this is not the start of something new. And we have, I think, 4 or 5 major gaps below the market that until this market pans out, I think those gaps will get filled. And I do think there'll be a time period this year that they'll make a new low. And then I think that, from there, I think we should probably base. So I don't think that the lows are in for the year. I think that this is really a monster short covering rally here. I don't think that, when it's funny, you mentioned 07, 08, but that was during the subprime market, the subprime debacle. Remember the housing market, the subprime. So that's when everything pretty much fell apart. The Bear Stearns, the Lehman Brothers, the mortgage-backed securities, the credit ratings on these mortgage-backed securities were overinflated. So it was just a domino effect. I don't see anything like that happening, but I don't think that the lows are in for the year yet. I still think, you know, we're going to proceed on the way down. We're starting to get really overbought now on the weekly charts. And again, running into a stone wall here of overhead resistance on the daily and weekly. I think they're going to turn back down soon.
So I mean, okay, so if you're not in the camp, obviously, that you feel like uh the bottom is in, you think we can see
No.
more pain. So how are you playing this? Are you buying puts? Are you going cash? What are you doing?
What we do here, we teach intraday strategies, my live channel, and people just trade, whether it's index futures, commodities, Bitcoin futures, equities, ETFs. We're just trying to capture the move. I mean, to this move today, Boeing was on the lows of the day, and something came out about defense spending and Boeing just ripped $7 and carried the S&Ps from the 94 up to the 58 level. I mean, you're talking 64 handles in less than close to an hour. That's a monster move on the market. And again, we're fueled that the Boeing started to lead it, the S&P started to move, and then next thing you know, short started covering because we had big sell reversals at one point this morning, right? We had the sell divergences on the opening. They pushed down to new lows of the day. Boeing was on the lows of the day. S&Ps were on the lows of the day. NASDAQ on the lows of the day. And all of a sudden, this news came out. I'm still trying to figure it out what it actually was. In the defense, I think they raised more money for the defense spending or something like that. And Boeing was named. And then you just saw a monster short covering in Boeing, buying in Boeing, and that just fueled the S&Ps and the Dow, and along with Microsoft. So Microsoft and Boeing really led this push up.
Got it. So out of all the names that you watch, and I know you have a list of about 30 names that you watch every day, are those the ones that have kind of been showing the most strength, or which ones, like today, are you watching and saying, okay, these ones have been real strong today?
Well, Microsoft's been a beast, right? After the earnings, it traded down aftermarket to 246, and now Microsoft's up almost 30 points off the lows of that. But overall, if you look at the market, once I saw Boeing started to edge up, and then there was a report about the increase in defense spending, and Boeing's name was mentioned in it, you just saw this thing fuel. It just propelled the market to highs for the day here.
Yeah,
and I mean, any little bit of news is going to trigger a short covering rally if it's bullish.
Right, and so we have Apple tonight, of course, and Apple, I believe, right now, I could be wrong about this. Someone out there in our wonderful chat fact-checked me. I believe Apple's the biggest weight in the S&P 500. So Apple, what Apple does this afternoon is going to have a lot of impact on the market tomorrow. Do you have any opinion on what you think Apple's going to do?
I really don't know. I mean, when I walk in the mall, the store's always crowded. So that's the only thing I can see. An iPhone 14 is coming out in September. I can't wait to get one. I'm still on the 10 series. So.
Oh, wow. You're due for an upgrade.
I'm due for an upgrade. Yeah.
Yeah. I mean, I was saying earlier, like, to me, I wouldn't be surprised, I guess, if people bought less actual hardware last quarter, but I have no clue. Like no one knows what Apple's going to do, but I guess it wouldn't shock me either way, I guess, to see Apple miss and be trading down 5-10%, and then tomorrow the market's down a little bit. But I mean, if Apple does well, then we've really had a pretty good earnings season so far.
Yeah, it depends on how these analysts adjusted for the, a lot of analysts brought numbers down, and I've been doing this August 1st will be 39 years. And a lot of times they bring the numbers down, and right before the earnings come out. And sometimes, it's calculated, for the market to see if they're going to make it or beat it or what. But it really is the revenue. I look at the revenue numbers, right? That's the real number that you have to decide.
Yeah, and so I've got pulled up right now. So the estimated revenue is $82 billion. To compare that, a quarter ago, Apple did $97 billion. A quarter before that, they did $124.
Those are the real numbers. Those are the real numbers you should be looking at.
So they're expecting Apple to go from 124 a couple quarters ago to 80. So that's a big decrease. But what's so funny to me, Steve, is, I mean, okay, the estimates are now, like, we've got it pulled up right here, 82. If Apple says, okay, we did 81, and the stock's down 5% tomorrow, it's like, okay, this company still made $81 billion last quarter.
Mind-boggling, 81 billion. You hear yourself, 81 billion. It's
right.
It's unheard of. You know?
And then the stock's going to be down on that news. People are going to say, "Oh my God, they missed numbers, whatever." And it's like, holy cow, you can buy this stock out there that's doing $82 billion a quarter. Like, are you kidding me? Like, this thing's a freaking monster.
Right. But I get, again, you know, we don't look at fundamentals here. We just wait for the news to come out, let the dust settle, and then we just take it from there.
Yeah. So looking at Apple's chart here, so we are, we're right at this kind of.
Look at a ton of overhead resistance here. I mean, you got a ton of overhead resistance here between the, what was that, the 55 and the 57, 58 level, or I can't read what numbers out there.
Yeah. So we're at 157 right here. So yeah, everywhere up here until we get to the 180 level, just a bunch of resistance, and then kind of topped out.
If there was good news in Apple and I was an investor holding, I'd be looking to. I think that the play is to liquidate longs if we did get a gap up.
Interesting. Let me see. Any other tickers you've been watching, Steve, today out of your list?
Just I'm looking at the ETFs here. I'm looking for a nice pullback here on the 15-minute time frame. Hopefully between now and 2:33. If we get that, I think we should, you know, make a nice pullback and then get one more push up into the close.
Got it. So you're as far as the action today goes.
I mean, look at that run up. Look at that run up there. I mean, that's all short covering. That's all short covering. That's all Boeing. That's, if you look at that, you put the Boeing chart right next to it. It's Boeing. Boeing caused this whole rally.
Yep. The Boeing chart looks pretty much identical. We're looking at the 5-minute candles here.
From 153 to 150, almost 160 in about an hour. All because of the increase.
So you think the lows are in for the day?
The lows are in for the day, yeah.
Okay. Interesting. All right. Risk it for the biscuit.
You can see all the four ETFs have the identical same pattern. You know, most of the stocks I look at have the identical same pattern as Boeing. You know, it's just, again, you know, you get a little bit of good news, and these guys got to cover shorts, and it just fuels the market. When you're in a bear market like this, the shorts are, you know, heavily short, obviously, and they just got to cover. You know, it just blinks against them in a way. You know.
Right. I did see someone in the chat saying they wanted to check out Intel, ticker INTC. I'm surprised to see Intel trading this low still, even after. I mean, you'd think Intel is going to be a big beneficiary of this new chips bill. But I could be wrong. But yeah,
well, AMD is really outperforming Intel, to be honest with you. So
AMD, you said?
Oh yeah.
Yeah, I mean, AMD and Nvidia have both been pretty decent, right? Nvidia's gotten this nice bounce up to almost 180 a share. Was down to like below 140 a share a couple of weeks ago. So
yeah, 130. But all these stocks, again, Aaron, just basic 101 technical analysis. You got a ton of overhead resistance here, and so it's just going to make it really harder. And then when they do roll over to make new lows, and they start basing, you need a basing pattern. From July to August, that's not a basing pattern. You need months of basing before you can resume a bull market.
I mean, yes, and I mean, but there have probably been times where people are sitting waiting for, you know, to they're on the sideline, they're waiting and waiting, thinking the bottoms aren't in yet, and they end up missing out on a nice little bull rally.
The market goes to extremes. You get significant overbought extremes. You get significant oversold extremes, and that's what I play a lot. I usually play the indexes on that, the ETFs. So to me, you know, I think when's the NVIDIA report? Tomorrow?
No, I don't think till later. Let's see. Yeah, not till later. August 24th.
Oh, yeah, to the end of the month. Okay.
Yeah.
You know, but again, you know, even if the higher the market goes, I think the harder it's going to fall. Those been around a long time. Those gaps below the market are going to get filled on the daily charts.
Let's go back to the NVIDIA daily chart. So you think this is going all the way back down here to 140?
Mm-hmm. I think it could make a double bottom, or even or even a new low. When again, if the market does what I think it's going to do, I think that's what's eventually is going to happen.
Got it. All right, well, let me give the chat a second to catch up, see if we've got any tickers that anyone else is watching. If not, just let me know if there's anything else that you've been watching, anything top of mind, kind of things to look forward to over the next few weeks.
Yeah, I mean, what we had that Goldman short above the 28 level, 29, dropped down to 18, made a higher low, and then propelled back up to 25, 27, 28, back up again. These are great trading markets. Volatility is really strong, and it's really predicated on understanding, as long as you're on the right side of the market, you're consistent. That's what I teach. I use my software to help go market direction and to be able to identify these trends. We had like sell reversals and buy reversals, and you can see these based on pure mathematics, and that's what people are really geared towards. They see the volatility, they're all jumping on board, they're all learning, and that's the most important thing.
100%. Yeah, I've got this Goldman chart pulled up here. You nailed that perfectly last week. Got up to what was it?
It was 329, I believe, and then dropped down to 318.
Yeah, wow.
But I mean, I don't think it's over. I think it's going right back down. I mean, if we get those gaps filled, the indexes are gonna, if I'm correct, they get dropped. All these stocks are gonna go with it.
I mean, yeah. I mean, if the I'm obviously hoping for myself's sake that we don't get all the way down here, but there's a lot of people out there, yourself included, Steve, that think we have not seen the bottom yet, that there's more pain in store.
Well, I mean, I'm not a fundamentalist, and I tell people all the time, you pretty much you trade there or buy here. You trade what you see, per se. And if you trade what you see, I think that, I think we're looking at things that are, I think that you have significant overhead resistance, you have significant overbought levels here now, and I think that you have, like I said, you're running into like a stone wall. The higher you go, I think the more they're going to drop.
Interesting. The higher you go, the more you're going to drop. All right, Steve. Well, always a pleasure to get you on,
Thanks,
man. Unless you've got anything else, we'll leave it at that for today. We'll get back to it next week. Always a pleasure to hear what you're thinking about the market, and you've nailed it the past few weeks you've been on the show.
Thanks, Aaron. Thanks, everybody. Have a great afternoon. Thanks, everybody.
Of course. All right, guys. That was Mr. Steve Kalajyian. Go to tradeeasy.com to catch more from him. We've got about 38 minutes left in the show. So we can do a few different things. One thing I do see some different sectors people want to take a look at in the chat. RB's looking at airlines. We've got Cody wanting to look at biotech, CRISPR specifically. We can take a look at those. But we'll also do another quick preview on Apple, just see kind of what Apple has done historically in its earnings reports. And you got to remember, so if you're trading earnings reports, it's not just about picking whether you think the company had a good quarter or not. You've got to understand that it's more important, whether or not the actual numbers, what the expectations are in terms of the market. So Apple is typically in earnings, they typically do well on their earnings. They typically beat. Apple likes to beat. They like to impress their shareholders. And yeah, risk it for the biscuit, saying that the true golden word here is guidance. The company can report terrible EPS and terrible sales for the quarter, but give rosy guidance, and then the stock's up 10%. Or vice versa. They can report great numbers, but give kind of poor guidance, and the stocks are down. And if you look at a lot of these stocks, Microsoft's, your Amazons, your Apples, a lot of these big drawdowns are because of guidance, because these companies have come out and said over the past few months, hey, look, there are a lot of headwinds right now. We're having to pay workers more. We're having to pay more for supplies. Inflation is hitting us as a business. Our numbers aren't going to look as good. Our margins aren't going to be as strong. And so that's a lot why a lot of these stocks are down are just because they've given this poor guidance. But then the back end is that, okay, now those expectations are baked in. You've already told us it's going to be a tough quarter. You've already told us you're going to make less money, right? Let's go back to that Apple scenario. Let's go to the financials. We'll go to their, let's go to our calendar tool here on Benzinga Pro. Again, pro.benzinga.com. You can sign up for your free 2-week trial, no credit card needed. Hit that link in the description. So we've got our numbers right here. These, I've got all the quarters going back to, I mean, I can go all the way back to 2012 if I want to, it's just a couple scrolls on my mouse pad here. But let's just stick to the last couple for shits and gigs. We went, the actual revenue numbers for the past few quarters, 97, 123, 83, 81, 89, 111, 64. So this is kind of where, this is this isn't pre-COVID. Damn, where's this huge, I don't know why you have this huge jump in revenue from 64 to 100 here. But anyway, you can see how low the bar has been set. I mean, we're going back now, the estimated revenue, 82 billion, the lowest in more than a year. We're going the opposite way. Usually companies like Apple increase their revenue every quarter because that's what companies tend to do. They tend to make more money and grow. And you want to buy companies, you want to own stock of companies that are making more money and growing. So the bar is set for Apple to have a disappointing quarter in terms of, okay, we're making a lot less. We made $120 billion a couple quarters ago. Now we're only going to make 80. That's, if you think about it, a third, 33% less than that 124 number in Q1 of 2021. So, Q1 2022. I mean, look, now it's not about, do you think Apple's going to have a bad quarter? They're not going to have a good quarter by Apple's metrics, by Apple's, top quarters of all time. So you got to think, okay, if I buy puts here and then they report, say $80 billion from revenue instead of 82, is that going to be enough? Do you think, while these expectations have been so low, is that going to be enough to really drag the stock down another 5 or 10% or what you may need on your puts? There's certainly a case for what Apple can say today that can bring the stock down that much. I'm not saying that's not a possibility, because 100% that could happen. But it will take a very, very poor quarter and bad guidance. Because otherwise, you're looking at the chart of a stock that everyone loves to own. Everyone wants to own, whether you're talking about retail, whether you're talking about institutional. And we did, let's zoom out here. I mean, we did hit lows of around 130 a share a couple weeks ago, back in June, mid-June. But we're still only at 155 a share. We were at highs of 182. This is when Apple was the, your world's first $3 trillion company, when we were at all-time highs. And now we're down here at 155. Like, if you get a quarter here that's decent, what about all these people here that want to own Apple that have been waiting? They're going to want to hop in and say, yeah, Apple is still decent. It's still at a good price. You're on sale from 185 a share to 155 a share. That's a $30 discount. If Apple projects high demand, what is that going to say about inflation? Well, that's a good question, Jonathan Lovelace. I don't know if the demand of Apple computers really gives us that much of a reading on inflation. I mean, if Apple's sales are good and people are buying despite inflation, I would think that's a good sign of the economy. I do think electronics is one of these areas. The way I see it is from a broad, and I mean, this isn't going to be, a perfect economic, it's not going to work like perfectly, but the way I see it kind of broadly is you can look at areas that had more spending than usual, people spending more money in these areas during COVID than usual. I can kind of fairly assume, I feel like, that you're going to have less spending in those areas going forward. Maybe not than before COVID, but just from those COVID highs. So if you think about the COVID peak of people buying MacBooks and tech and TVs for their homes, I don't think that same rate is going to continue. That doesn't mean people aren't going to be spending the same amount of money they were during COVID. It's just going to be in different areas. People are spending more money now on traveling and travel goods, whether it's luggage or nicer clothes, right? You've seen different apparel and clothing companies come out and say that. That's saying, hey, look, we're seeing the consumer behavior change where instead of buying more athletic and leisure gear, people are buying more like business casual and nice gear. And think about it, that's just logical. During COVID, when nothing's going on and you're chilling and lounging at the house all day, you want those new Nike sweatpants. You want that new Nike sweatshirt. But now that COVID's kind of cooling off, maybe you're taking trips again for business. Maybe you're going to see friends in Vegas for the weekend. Maybe you need some more. You need some more nicer clothes. And I think there are a lot of people out there in that camp with computer equipment and electronics that they bought everything they could possibly need during COVID. And I mean, sure, you're going to need to upgrade your laptop every couple of years or so. But I bought this MacBook during COVID. I bought this, I want to say 2020, December 2020. I've had it almost, I bought it December 20. Yes, I'll have it in 2 years in December. I don't really need a new one. Like, sure, I could. Jonathan saying, so if travel demand is high, what does that say about supply and demand of oil in the future? It cuts all ways. I mean, Jonathan, I must just be missing your point here because, like, I would see that if travel demand is high, then that'd be good for the economy. I guess I get the point that you're making that if people are still spending money, that it's not going to limit inflation. Inflation's going to remain high. That can eventually be bearish if that's your point. I understand that. New kids go to college every year. Every year, kids buy laptops. Yeah, but is that enough to maintain Apple's growth? And I've actually been seeing numbers that I think right now, like less and less kids are going to college, which I'm all for. I mean, you can look at like the average wage that someone's making after 4 years of studying certain degrees versus what you would make just going to trade school and learning something like how to be like a plumber and electrician. I mean, like I remember like learning about that while I was in college, being like, wait, if I just would have went to trade school and was a plumber, I'd be making 120 racks right now at like 23 years old. Like that is a very, very, especially if you're into this shit. If you're into investing and you're into buying stocks and you're into, being financially independent, being a skilled tradesman, like being essentially like a plumber, a carpenter, an electrician, or someone where you're making say 100 grand at 23, 24, and you don't have, any student debt, and you can start saving and putting money into a Roth like at that age, like that's how you're really setting yourself up. So I think that's good for the economy if less kids go to college right now, kind of help fill these voids we're seeing in different trades. And then yeah. And it's always a good backup. Like, I don't know if anyone ever, hates what they're doing. It's like, go to trade school, do something with your hands. You work for 8-9 hours a day. I thought the high oil prices reduced the amount of travel. I mean, right now, air prices have been elevated from the higher oil prices, and people are still traveling, right? We can look at the let's actually do this real quick. Let's look at the TSA checkpoint numbers. TSA total traveler numbers. So, let's look. So 2022 checkpoint current year versus years prior. So we're below 2019 pre-COVID, but well above 2021. Like, so even with the higher ticket prices, people are still traveling. The only thing I could imagine why you're still lower, you're still a couple 100,000 people lower than 2019 is, I'm curious how many people like were traveling for work right here that then don't need to travel for work anymore because this meeting where we were going to fly from Detroit to New York is now just a Zoom call. I'm not saying that's all 300,000 of that, but it's got to be a decent amount, just a decent amount of people who, would have been traveling for work that aren't anymore because, there are more efficient ways to do it. Yeah, Jonathan Loveless, of course. I always, I think one of the things that has been maybe a bad part about social media is I feel like it's actually gotten us further away from having like healthy discussion and healthy debate. I don't even know, honestly, Jonathan, if we were disagreeing there, if you disagree with me or if I disagree with you. I don't know. But just in general, whether you're talking about on YouTube, on Twitter, on Reddit or anymore, like people like don't ever want to have like a civil conversation where they disagree. If people disagree, it like goes immediately to like you're a freaking idiot. Like I can't believe you would think that, and like name calling and stuff. Where it's like one of the coolest things about social media is the fact that we do have the opportunity to converse and interact with like hundreds of different people at the same time. There are 230 people in this chat from not just all around the country that might have different upbringings and walks of life in the country, but around the world. And I think, I think we should embrace that debate. We should embrace these conversations. And if anyone ever wants to hop on the show and discuss things with me, maybe things we agree on, maybe things we don't agree on, would love to do that. Trade shows have resumed, so a bit more travel for sure. Yeah, and I think that's going to be the trend. I think I think more and more companies, more and more people are going to be traveling, and that's been the bottom line. Is like travel numbers have been decent. So with higher ticket prices, and let's go back to my Benzinga Pro. You got to think some of these. Okay, I got to be honest with you guys. Okay, here's what I need to do. I need to bring on an analyst of someone who covers maybe an airline company or the airline industry. Because right now I'm starting to just think that airlines in general don't like. I don't know if they're not good business models. Like maybe they don't make a lot of money. Maybe they all need to spend a lot of money. But like for some reason, the stock market just doesn't like them. For some reason, the stock market just does not like airline stocks. And it's not just, recently or because of COVID or anything like this. Like let me pull up. Let's look at a weekly chart here of Southwest stock. So going from, I mean, look, okay, yeah, you got this huge, you had a really strong run in Southwest stock from around 2011 from $12 a share up to $40 a share. That's a very strong run. That's like 300, 400% in a few years. But even from, like looking at from 2017 to before COVID, this thing was like flat. This thing was actually down. And that's while the market was going up from 2017 to 2020. Like the stock market, for whatever reason, seems to look at airlines and just not love them. I mean, and same thing with here. I mean, look from 01 after the 01 crash to 08, we were in a bull market. Stocks were going up, but Southwest wasn't. Southwest had one really strong run here, one really strong run here, and then a lot of trading sideways. And then historically, you have a bunch of airlines. What's the one that Carl Icahn what was in TWA or whatever? Like that one went out of business. So like, I don't know. I'm starting to think that the airlines just don't get any love from the stock market. I do think something like this Jets ETF, again, we're looking at a weekly chart here, does get interesting at some point. We're still well below our pre-COVID levels. We were at $30 a share pre-COVID on this Jets ETF, which tracks all the biggest U.S. airlines and airline manufacturers. But I mean, $17 a share. And we were just looking at the travel numbers that look pretty decent. They don't look amazing, but they look pretty decent. And if all these airline tickets, if the price of airfares are higher, you got to think they're able to pass off some of those additional costs to customers, thus putting some of these companies in a potentially decent position to actually report some strong quarters. So I don't know. I mean, I'm very torn. Remember, so someone remind me to get a airline analyst on here. So I just want to know, like, is it just a problem with all airlines that the market doesn't love them? Are there some that are actually like making money and decent investments? I don't know. But see, like that's why I'm thinking like they aren't like great investments. Like maybe they just aren't that profitable. Like they always need the government to be like holding their hand. They can't just go off and like flourish on their own, like an Apple or like a Google, like someone who's like actually like making a lot of money and like like I feel like I feel like airlines are operating more out of just like a public utility. Like we need them because we've gotten used to being able to fly from Detroit to Salt Lake City, and it's not like Southwest is doing that flight because they're making thousands and thousands and a bunch of money. Like they just are. To me, like, I don't know, like maybe they shouldn't even be for profit. Like maybe we'd all be happier if they weren't for profit and we could just fly somewhere for cheap and we knew they couldn't cancel our flights. Like I don't know. Like it seems like these airlines historically have not been great investments. But I mean, from a chart perspective, like if you're looking at the Jets thing, like we're looking at a weekly thing here. Let's go back to Love. Let's go back to Southwest. Like you could trade them. They swing. They make moves. Like the COVID, they got hit, of course, like everything else, got a big rip. I mean, Southwest actually got a lot higher than it was pre-COVID at one point. And travel numbers were never anywhere close to where they were pre-COVID because we had gotten all those, we had Zoom and less need for air travel. So, I mean, I don't know why it got that high, but you can certainly trade it. You can certainly trade these. I just wouldn't buy and hold a lot of these airlines like as an investment historically. Haven't been great. Maybe there will be one that comes along and is great. Maybe it'll be a Tesla airplane. They don't need to pay for jet fuel, and that's why. It can drive itself. Speaking of Tesla, check out how Tesla's doing. I mean, Tesla, this thing don't quit. What's they have option contracts? Who has option contracts? Airlines lock in future prices of oil, you're saying, Shelly? That makes sense. Apple will destroy short sellers today. Yeah, I'm kind of with you there. Like I've talked about this too. Okay, so I'll give my quick kind of prediction or what I'm seeing based on what we've seen from other earnings so far. Amazon and Microsoft and whatnot, like their strongest parts of their business they're reporting were from cloud. Apple doesn't really have that same cloud part of their business. Apple is much more dependent on its hardware sales, on its sales of its MacBooks, of its iPhones, of its watches, of its AirPods. And I wouldn't be surprised to see those down for the quarter, but I think you would need Apple to either have like a way, way, way worse quarter than expected, or them to say, okay, we are seeing consumer demand changing. We're expecting people to buy less MacBooks for the next year. Like something like that can really cause Apple stock to go down 5-10%. But outside of that, I don't think just a slightly worse quarter is going to be enough to really bring the stock down like 5-10%, like what some short sellers might be looking for, or for what some people buying puts might be looking for, which could then just cause, right, you can get like a not great quarter, the stock down, say 2 or 3%, and it gets people that have bought in these out of the money puts, forcing them to cover, saying, okay, I'm not going to make money on these puts anymore. I got to get in and cover. And then it causes the stock to go up. So I agree, Hema, that Apple will most likely destroy short sellers today. The only caveat to that, to the point where short sellers could win today, is if A, Apple's quarter ends up being a lot worse than expected, or B, Apple gives some guidance where they're saying, okay, we are seeing people buying less computers, buying less iPhones, or buying less Apple Watches, whatever it is. I personally, Apple has a long, long history of performing well into earnings. I do think you're kind of getting to this point right now where, look, Apple's Apple. Like it is what it is. Like if Apple is down 5-10% after its earnings today, I'm probably just going to buy some. And then if it goes down another 10% from there, guess what? I'm just going to buy some more. And then in 5 years from now, I'll look at it and say, hey, I'm glad I bought some Apple there at 135 or 140 bucks a share. You know why? Because Apple's a freaking monster. And if we go back to this tab, we can see that Apple made $97 billion last quarter. That's in a quarter. That's in 90 days. That's about 90 days. Apple made $97 billion a day. That means I'm owning part of a company that's making $1 billion a day. Oh, and guess what? The quarter before that, they did $124 billion in revenue. Quarter before that, 80. Quarter before that, 81. Quarter before that, 90. Quarter before that, 110. So, I mean, like what? That's Let's see, 97 plus 123. That's gonna get you to 220, and then you're gonna be looking at another 90. So call that 310. Another 80 right there. Call that 390. 480 plus another. So you're looking at a company that did $590 billion in revenue, half of a trillion of dollars in revenue over the past year and a half. Are you kidding me? Like, and what, we're gonna freak out because if they do a little bit fewer sales this past quarter? Like, this company is an absolute monster. My thesis is that Powell's plan is to let Apples do the job that raising rates should have on the market. Interesting. I mean, we would have to see Apple like to have a big impact, not only on just on Apple's stock, but then of course that would have a big impact on the overall market. I think we would need to have some like big surprise news to the downside. I'm just saying, I don't think like your run of the mill, kind of meh quarter, weaker quarter really destroys the stock here. It's already down. Look, I mean, I just ran through the revenue for the past like year. We're talking about a company that's made over half of $1 trillion in revenue over the past 2 years, and the stock's already down from 180 to 156. Let's see, from its peak. Let me do some quick math here. From its peak, Apple's stock is still down 12%. You're able to buy a stock. I mean, it's well off its lows. The stock was down 27% when it was at 130 a share, and now we're back up to 156. But you're still talking about it's already down. It's already down 12% from its highs. Like, I don't know if it needs to go down further from its highs based on it being an okay quarter in what could be the worst macro environment that we've seen in the past, 20 years. I think a lot of people have argued that the past 6 months have been a worse macro environment than even right when COVID hit. I mean, when COVID hit, it was the worst it's been since the Great Depression for about 2 weeks. Then you had the Fed really stepping in, and you had a lot of people kind of feeling more comfortable as the days went on, and we learned more about the disease. But in terms of just like the overall myriad, just a different, negative headlines when you're talking about China, whether you're talking about Russia and Ukraine, whether you're talking about inflation, we were just getting battered with bad headline after bad headline. And it got to the point where you're looking around saying, okay, what else can happen? How much worse can it get from here? Like, sentiment is already bottoming out. People are already as scared as they can be. We talk about fear and greed being the two main emotions that drive the market. We were basically tapped out on the fear index. And now, people are feeling a little bit better. Why? I don't know. Things haven't really changed for the most part. It's not like the war in Russia and Ukraine is coming to an end. We've talked about inflation a lot. I don't think a lot of people right now, I have no clue. I'm sure there are some people out there that believe it, but I think a lot of people out there right now don't believe that inflation is getting worse. So maybe like 2 months ago, they were seeing inflation just thinking, okay, this thing is just going to keep getting worse and worse and worse. And I think a lot of people right now are in the same camp I am, where they're saying, okay, inflation is still way too high for comfort. But at least, looking at the silver lining here, it looks like, at least for the time being, that inflation is slowing down. I think that's one thing people are looking to in solace right now. Apple layoffs will be a good sign of a bottom, Jonathan, potentially. I think, you have layoffs, you have hiring slowing down. Like, what if Apple doesn't lay people off? What if they just freeze hiring for a few months? They slow down hiring. Like, is that like the end of the world? Like, that's what the economy does. It grows. It goes through cycles. You're going to get growth cycles. It's going to slow down a little bit. You're going to grow again. You're going to get growth cycles. And what does the market do over time? It goes up. It's going to go up. It's going to dip down a little bit. Then it's going to go up. Then it's going to dip down a little bit. So, look, guys, bottom line, I don't have a crystal ball. I don't know what Apple is going to do in earnings today. I know what my expectations are. I know what my expectations are for the market's expectations. So if Apple does this, I expect the market to react this way. If Apple does this, I expect the market to react that way. And figuring out how I want to play those. Figuring out if there is a way I do want to play those. Maybe I'd rather wait and just see what Apple does, see how the market reacts to it, because the market's reaction will then give me a better idea of the overall sentiment of the market. That's fine. I mean, I think that's a fine plan to say, okay, I don't need to hop in here and buy these calls right before or right after. Oh man, I had some QQQ calls earlier that I sold that would have been up a bunch right now. Oh well, woulda, shoulda, coulda. They're already slowing hiring. It's enough. Oh, America's the entire floor of the company. I don't know what you mean there. America is the entire floor. Are you talking about? I don't know. I don't even know what you're talking about. Unemployment rising correlates to topping inflation. Yeah, and I think that's. I mean, that's what Jerome Powell and the Fed has basically said. They've basically said, I mean, whether or not they want to say it or not, they basically said, yeah, I mean, like part of limiting inflation usually comes with employment coming up. And that's just how things typically work. But I mean, I think you can have both. I think you can have inflation coming down with maybe unemployment slowing down, but maybe unemployment doesn't need to have this drastic uptick. So I don't know. I think we'll see. Catching up on CNBC. Looks like they're looking at AMT, American Tower. Check that out too. I haven't checked out AMT in a while. Up 3.5% today, getting that nice little CNBC bounce right now while they're talking about it. Yeah, I agree. I mean, honestly, as an Apple shareholder, like historically, the best advice you can get for an Apple shareholder is just buy more on dips and hold it, because over time, I mean, I honestly, this is if you had to ask me like my favorite or just GOAT stock of all time, like this thing is the Michael Jordan of stocks to me. I mean, look at this thing on a monthly chart. Where my cursor is right now is going back to 01. I mean, this thing has just gone berserk. Stock split after stock split. I mean, this thing is, even if you would have bought it in 2010, so this is like, late stage for the company. This is, post iPhone, post iPod, everything. If you bought it in 2010, I mean, think about it this way. In the movie Forrest Gump, the whole plot line was that he got rich off buying Apple stock. Not the whole plot line, but that was like the joke at the end, was that he bought, he's like, oh, I bought stock in this fruit company and made a bunch of money. What year did Forrest Gump come out in? Forrest Gump came out in like, let me look it up real quick. I'm going to guess 99? 94. Forrest Gump came out in 94. So if you would have bought Apple stock when the joke in Forrest Gump was that Forrest Gump had bought Apple stock like 10 years before and gotten rich off of it, that was at what would have been today 41 cents a share post split, and it's at $150 a share now. So you could have been so late on this, and you could have been, okay, so that was in 1994. If you would have waited 15 years after that in 2009 and bought it at $2.90 a share, then you're up at 150. I mean, this thing is I just don't know how to express, like, in words, just how crazy going through those numbers were earlier, how much money Apple really makes on a quarter-to-quarter basis, and just saying, like, yeah, you have the opportunity out there to go to your stock app, Robinhood, Webull, whatever, and own part of this company. Own part of this company that has just done amazing things over the past 30 years. Futurama did a joke about Amazon stock, the coffee episode. How long? Yeah, I mean, how long ago? It's crazy. Breeze hair reflects how much he's stressed right now. I'm not stressed at all, Shelly. I'm chilling. Also, I haven't looked at my hair. Oh, my hair is messy. This, you can see where this headphones thing comes on here and starts messing up my hair. It wasn't that messy before I hopped on, I swear. But I'm not stressed right now. I'm not even playing any like options. I'm actually kind of pissed that I sold these QQQ calls because they're up about 200%. I sold them for about a 50% gain, so I missed out on about 150%. But again, woulda, shoulda, coulda. You can never be mad. taking profits. Okay, so Aaron Bryan saying Futurama made a joke about Amazon stock in 2003. Yes, maybe that's the key is you got to pay attention in movies and shit like Forrest Gump and saying, okay, if they're making a joke about this stock, maybe it's not too late. I think that's hilarious, personally. That in 1994, that was the joke that he bought Apple stock and got rich off of it, and then the real think about how rich Tom Hanks would be if he would have taken his Forrest Gump money and then bought in real Apple stock in 1994. Limitless, yeah, great movie. Bradley Cooper. I think they made that into a show. I haven't seen the show, but the Limitless movie is a classic. Brad Cooper. I remember watching that in when I was 13, thinking he was the coolest guy in the world, thinking I need to find me some Limitless drugs. Who did Futurama or Limitless? Spy going for 411 today, Quantum. Let's go ahead and pull up the Spy. I mean, look, if you wanna trade some Spy options here, I'm not gonna twist you. I'm not gonna stop you. And 404. Ooh, I mean, look, if you think we're going to 411 today, more power to you. That's a big move. I mean, if we're going to here, let's look at what the Spy 411 calls are that expire tomorrow. I'm gonna guess they're about 80 cents. Expire in July 29th. 411. Oh, they're 29 cents. These things are cheap. Yeah, I mean, your break even is Spy going up another 1.7% before tomorrow afternoon. That Leah with a shot collar episode did numbers on me. I don't know what that means, Shelly. That doesn't surprise me, Aaron Brian. I think a lot of the funniest stuff out there, I think a lot of really smart people put their kind of, I don't know, put their view out there on it through comedy, through satire is the best way to get their message across. If you think about South Park, a lot of stuff South Park has done over time has just ended up being absolutely genius. And same thing with Futurama. I think humor and satire is a very underrated way to get serious messages and points across. Yeah, Jonathan saying he was not sure he'd want 411 on this volume. Yeah, I mean, if anything, I'd wait. If you're really bullish Spy in tomorrow and you want to play that on some YOLO calls, what I would do is I'd wait for maybe you get, I'm on a 5-minute chart here. Maybe you get a couple red candles here, row on a 5-minute chart. And then you buy some 40. Oh, wow. If that was real, that'd be bad. And maybe you buy some 408, 409 calls. Give you a little bit more room than those 411s, because I mean, that'd be a hell of a run. You would get another. Well, let's check out Spy on the daily here. I'm curious what the RSI is. Let's do RSI, relative strength index. We're up at 62, so we're not getting super overextended here, and it does look like, if you want to consider this a gap here, that we do have a little bit more to fill this gap up to that 412, 413. But I'm not that bullish on that. I'm not that convicted on that we can hit 411 on the Spy in the next 2 days. I'd rather just wait. I mean, I think your biggest catalyst here is going to be, of course, Apple's earnings tonight, and then I believe we also get PCE tomorrow. Let me double check. Friday, yeah, PCE inflation index and core PCE 830. We also get real consumer spending and a bunch of other economic data tomorrow morning. So we do have a few catalysts here. I mean, I wouldn't mind having some bullish exposure in the short term going into PCE tomorrow, just because the PCE, the Fed actually cares more about than the CPI, because it's seen as a more forward indicator of inflation, right? It's your the PCE is, I believe, the producer's consumption expenditure. Let me see, what does PCE stand for? Personal consumption expenditure. So what is the difference between, let's learn together. Let's learn together. CPI probably gets more press and then it's used. The Federal Reserve, however, states its goal from inflation. I thought the producer, or sorry, the personal consumption. I was under the impression the PCE came more from employer, from like businesses. Okay, yeah, exactly. The PCE is based on surveys of what businesses are selling. The CPI is based on the surveys of what households are buying. So the PCE is based off more the numbers that the businesses are putting out, which can be seen as a more forward indicator, because if the businesses are saying, okay, we're putting shirts out for $10, maybe the households are still reporting that they're buying shirts for $15 because they're talking about shirts that they bought last week, even though now the businesses are listing them for $10. So the PCE, the Fed looks at it more. So the PCE is going to be important tomorrow, and I wouldn't be surprised to see that come in on the good side, a little bit lower than expected. But with that said, it is 1 p.m., so that will be a wrap for us today. Loved hanging out with you guys today, this Thursday. It was great to be back. I missed hanging out with you guys yesterday. Please smash the like and subscribe to the channel if you have not already. Money Mitch is coming up right now. He will be talking to... Oh, wow, that was bad timing. My Google Calendar logged out on me while I was trying to see who Mitch's guests are. Give me 1 second. He'll be talking to Joanne Feeney, the portfolio manager and partner at Advisors Capital Management. And yeah, he's going to be talking to, as well as Chris DeMuth, a hedge fund manager at Rangeley Capital. Mitch is going to be talking all about the different stocks people are, trading today. Easy Mike, Urban Farm, Shelly, Aaron Bryan. Guys, appreciate you all. We'll be back tomorrow. Till then, love you guys. Stay green.
This is Benzinga.